Assalamualaikum and have a good day everyone. My name is Siti Nur Izzavanti Mat Khalid from JBA 2423G. My matric numbers is 2022978237. This video presentation was prepared for Sekama Fahru Razi, which related to the topic 3 and also 4 in Advanced Corporate Finance FIN544. As I said before, we will discuss two chapters which are related with the capital structures and limit to the use of debt respectively. During the research, I found that capital structures is important for a firm in running a business. In addition, there are several factors that cause a firm whether showing a good or a bad performance. Next, to make a firm organized and grow, there are several actions and responsibilities that need to be carried out by the management company and the shareholders. It includes in terms of theory of internal and external sources, calculations, and graph sketches to identify more clearly what will happen if the firm exceeds the maximum line. Capital structure could be defined as the arrangement of long-term funding sources used by the firm to finance its overall growth and operation, which in particular includes its equity and also debt. For instance, bonds, preferred shares, retained earnings, long-term shares, equity shares, debentures, and etc. Both debt and equity could be found in a balance sheet. A firm's financial structures is measured by its debt to capital and also debt to equity ratio. Moreover, capital structure is important for a firm because it largely determines the stability of the firm. We go through on how to determining optimal capital structure. Optimal capital structure estimated by calculating the mix of debt and equity that minimizes the weighted average cost of capital, which is WACC. In order to determine the optimal capital structure, the firms need to find a lower or a minimal WACC, which it will provide an appropriate conclusion. As a result, they don't have to bear with the multiple debts. Next, when their cost of capital is lower, it will reflect the greater present value of the firm's future cash flow, discounted by WACC. Moreover, steps must be taken in order to determine the optimal capital structure. Step number 1, the firm should look for a different capital structures with a different debt to equity ratio. Number 2, calculate the cost of capital and cost of debt at the different levels of capital structure. Step number 3, find and calculate the weighted average cost of capital. Step number 4, through the graph, we may find the optimal levels of capital structure. Next, the factors affect the capital structures and capital structure decision. There are a few factors that affect the capital structures and capital structures decisions. However, I will present 4 factors. The first one is return on investment, which is ROI. The great return on investment shows that the firm could pay its lender with enough money. The firms is preferred to prioritize debt when the return on investment is more than the interest rate, while the firms are advised to prioritize equity when the return on investment is less than interest rate. However, if the return on investment remain the same, an increase of the cost of capital will reduce the profitability of the firms and also the shareholders' wealth. Second factor is cash flow positions of the firm. The firm will issue more debt if they face a higher cash outflow positions. It is because the capital structures has a direct impact on the firm's company cash flow ability. The cash flow positions will be analyzed to know the result of the liquidity positions on the businesses. In order to prevent the firms from inability to pay debt, the cash inflow must more than the cash outflow. The third factor is the size of the company. The size of the company is one of the factors that affect the capital structures and the capital structure decisions. A small size firm tend to face a difficulty in raising a long-term borrowing because some of the financial institutions will provide a high interest rate to the firm. However, the large-sized firm usually get easy access to borrowing since they have a higher capital. The last factors I would like to share is tax positions. If the government put a policy that requires to pay the terms of tax in a high rate, the firm have to pay a high corporate tax which directly influence the decisions of capital structure. The tax position also played the role of issuing equity shares and debentures. Next, moving on to the financial distress. Financial distress is the financial institutions in which a firm or individual cannot meet or has difficulties completing its financial obligation to its creditors, or when the firm's revenue are insufficient to cover its current liabilities. From Ross, Westenfeld, and Jeffers said that the financial distress is the situations where a firm's operating cash flow are not sufficient to satisfy the current obligations and the firm is forced to take corrective action. This is typically due to the high fixed cost and high liquidity assets or revenue of the firms that is susceptible to the economic downturns. Moreover, individuals may experience financial distress due to poor budgeting, overspending, and excessive debt load which exceed their monthly income. Next, there will be the time where the financial distress no longer could be resolved since there are too many obligations and could not be repaid. If this situation happens, bankruptcy may be the only one option left to the firms and the individuals. There are two types of financial distress. Number one, ex ante, which is before the event. Number two, post ante, which is after the event. Next, integrations of tax effects and the financial distress cost. There is a trade-off between the tax effects and the financial distress cost. As we know, financial distress is about bankruptcy when the profits are less than the liabilities. Based on this graph, the red line indicates the actual value of the firms while the blue lines indicates the value of the firms with the corporate tax and its debt. Next, the area between the blue lines and the green lines, which is the value of the firms with the zero debt, shows that the present value of the tax shields on debts. While the area between the blue line and the red line proves that bankruptcy cost, also known as the present value of the financial distress cost. If the distress cost exceeds the tax advantage, the value of the firms will decrease, which tends to increase the risk of bankruptcy. Therefore, the firms cannot borrow a large amount of money since it will lead to bankruptcy. However, the graph shows the conclusions of trade-off between the tax and the financial distress cost. The graph also shows the optimal amounts of debt that the firms could only borrow in order to avoid the financial distress, which is the bankruptcy. Moving on to the agency cost of equity. The agency costs incurred by a firm as the result of the problem associated with the conflicting of the information asymmetry that exists between the principal, which is shareholder, and the agent, which is management. The agency cost of equity emerges from the difference interest between the shareholder and the management. The shareholders has to bear some costs when the managers of the firms is markedly different from an interest of the shareholder for any reason. For instance, the management think that they will expand the business by merging, while the shareholder feel like it's such a waste to pay for a merge. They are not synced with each other. However, a free cash flow hypothesis says that the growth in the dividend should be advantage to stockholders by reducing the ability of the managers to pursue a wasteful activities. We continue to the pecking order theory. Pecking order theory is also called a pecking order model, and it uses the asymmetry concept. Pecking order theory is a theory related with directly to the capital structures of the company, where the managers are required to follow a specific hierarchy when choosing the sources of finance in the company. The first preference is given to the internal financing. Then, moving on to the external financing when the funds could not be raised internally. Debt will be issued first to generate fund, and lastly, issue the new equity if the fund cannot be raised through the debt as well. Donaldson first suggested this theory in 1961 and later modified it by Mayers and Majluf in 1984. This theory might not always be the optimum way, but it does guide how to start financing. Next, signaling hypothesis. In signaling, the managers actually knows more about the company's future investment and knowledge than the investors or shareholder, what I call asymmetry information. Signaling hypothesis occurs when the managers and the stockholder try to agree with the same information or idea we call as a systematic information and try to overcome the problem of asymmetric information. When the firms announce an increase in dividends payment, financial analysts and investors read it as a positive sign of a company's future financial outlook. The higher the profit that the firms receive, the greater amounts of the dividends that the company will pay. In conclusions, from all the information and research presented in this video shows that a great financial management in the firm organizations help a business to run smoothly and grow more from year to year. Next, with a better control in the capital structures, firm can control their debt management for the use of these funds. However, the more debt a company takes on, the more cash it has to generate sales. Therefore, the firm has to find the right balance between debt and equity for an optimal capital structures, which can then be leveraged to the growth of the business. That's all, and thank you for watching.